I'm going to try to save the banks. And there is indeed a distinction between what I would call retail banking, where I see fintech making big inroads, and corporate banking, which is something very traditional. I mean, some people would say that talking about corporate banking in Florence is a good thing because they have some tradition. And my proposal to save banking is non-mainstream. I would not be surprised if most of you disagree with what I'm about to say. But I think it's going to be, as some people who read my paper said, a good debate. And let me start with a massive disclaimer. This is really just me. I work for a number of development banks, European institutions, and so forth. But this is really just me. Don't take it any further. I'll start by citing Luigi Einaudi in Italian. This is an economist, governor of the Central Bank of Italy, and president of a republic, the second president of a republic. He came out in 1934 with an article called Debt. It's a journal article, very impressive writing. He starts out with an argument that he doesn't follow through. He starts out by saying that if debt did not exist, and every investment were to be remunerated by variable income coming from the bottom line of a company, then there would be no crisis. It's an impressive statement that he then proceeds to dismiss throughout his paper. Say, no, forget about this. I mean, lawyers and arrangements and institutions and certainty and information, you can't really live, you can't really run an economy without that. And I pretty much agree with this article when I was a student, until I started reading religiously every 6 months the European Central Bank Access to Finance Service. So this is a real contribution to research. When economics of information, credit constraints, credit rationing came out, all empirical studies were plagued by the difficulty of disentangling demand and supply effect. Surveys tried to get a hold of demand for financial services. So I thought Luigi Einaudi was a paradox, was just a paradox, until I started looking at this chart. So what this chart does is ask a sample of Euro area small businesses which sources of financing are relevant for their company, and whether they have used them in the past 6 months, whether they plan to use them, or whether they're not relevant at all. And so I don't know if you can read, but coming from the left is overdrafts, used and pretty relevant, leasing, bank loans, trade credit. What strikes me in this chart is that it's mostly yellow. The areas are mostly yellow. And even the bank loans, even the bank overdrafts, 50% of the companies say not relevant. And is this a nowadays world, a world without debt? This is not invented, this is real life. These are companies who work without debt. Probably they're not the largest corporates, very leveraged. They're not the big innovators, startups. They also have a different model, but solid cash flow producing startups may be interested in that and not getting it. They may be in the light blue zone. But you get 50% of the companies just not interested. So I stare at this chart a lot, and I decided to flip it upside down. It's even more interesting. Once you flip it upside down, you just realize how yellow this whole chart is. But they also tell you in the third column from the right that equity is not relevant. Next question, and then I'll move quickly to the punchline. Is it possible that it is the instruments that are currently available served in the financial system that are not relevant, and maybe a different instrument, a different way of intermediating could be relevant again? And I found some hints in Frank Knight's work. Frank Knight wrote nearly 100 years ago about risk, uncertainty, and profit. We are all taught in undergraduate courses of risk and uncertainty. In statistics, we always talk about that. We rarely talk about the profit side. And the whole point of at least the chapters I was able to digest and read in this book is that the entrepreneur shoulders the uncertainty, so carries the uncertainty on its shoulders, and provides certainty for the salaried, for the suppliers, for the client. The entrepreneur is really an intermediary in uncertainty. It transforms uncertainty for certainty, and the price for that is the profit. So question is, we have an over-leveraged economy, investment is anemic, we have uninterested small businesses in borrowing. Could it be, and here's my hypothesis, could it be that entrepreneurs are looking for someone who would share the risk? I was walking around Florence, visiting a few bankers' palaces, and they were talking about the risk participation, the way the ancient Florentine bankers used to work with the small businesses or larger businesses for those time. And here's what I really want to say, and I know none of you is going to agree with me, but I think it's a good debate. So let's assume that we allow bank to provide equity finance to small businesses. And we're going to do this under three conditions. So a bank is allowed to invest in a business under three conditions. First of all, the business receiving equity finance from a bank gives up borrowing. So if you are invested into by an intermediary, you give up borrowing. Presumably the banks have a lot of information about their customers. They still intermediate most payments. They probably channel the wages that are paid. They get to see the invoices, they get to see the money transfers and so forth. I mean, barring fintech, but they have information, so they could hopefully choose well, but to avoid the conflict of interest, you prevent companies, and there are companies seem to exist. There seem to exist companies that are not interested in, at least 50% of them are not interested in borrowing, but they may be interested in equity injections. So the bank would participate in the risk, but also the profit of the firm. Second condition, probably we have to ensure fair treatment of equity and debt. I mean, an entrepreneur that is unleveraged or unlevered should not be paying really the same taxes of an entrepreneur that is levered. If we take its externalities into account, if we take a number of, this has been discussed, there's plenty of proposals on the table. It's certainly not something I'm proposing first. It's out in the public domain. Not easy, because when you start eliminating tax deduction of interest rates, then you all of a sudden you remember, oh, how about financial institutions? How do we treat the financial institutions from a tax point of view? Very different from non-financial companies. Not easy, but perhaps a lower tax rate with lower leverage and a larger tax base could do the trick. And then finally, let's even assume that Modigliani Miller applies, that a bank that is 100% equity finance is not any riskier than a bank that is, a company that is 100% equity finance is not any riskier than a company that is 100% debt finance. The risk of the assets is the same. There'll still be an issue of liquidity. If you are a bank and you accept deposits and you invest in a very illiquid instrument that has very uncertain cash flows, you can't really manage your liquidity, financial stability issues, and so forth. So we believe that one should be able to securitize this equity. And let me tell you, small business loan securitization has been very difficult. There is a great success of a European Commission who managed to get a new set of rules approved for simple, transparent, and standardized securitization just 2 weeks ago. And these rules go hand in hand with the idea that if you allow banks to securitize small business loans, there will be more access to finance for businesses. It's very difficult to securitize small business loans. And I'll just give you a hint of why. Think about residential mortgage securitization. You've got one borrower, one intermediary, one asset. Very simple to track, put in a portfolio, granular, and very simple to identify. You try to do small business securitization. A small business that borrows typically borrows from more than one bank at different maturities. Even with the same bank at different maturities with different lines of credit, also all issues about cross-default and so forth. Multiple assets given a security potentially attached to different loans. Fiendishly difficult to put together a small business securitization. It is done, it's useful, it helps many intermediaries, but now think of an equity instrument. An equity instrument, you would only have one class of shares. For a small business, there will only be one investor, one bank, and there will be no issues about collateral. It will work a bit like a mutual fund, and because equity has both upsides and downsides, you may achieve diversification at a different number of investments that you would do with small business securitization. So these three conditions together, if you're invested, you cannot also borrow. You get some fiscal advantage, and I believe this has been tried in Italy and other places. And thirdly, banks should be allowed to securitize this equity, quasi-equity, could indeed do the trick and take advantage of a bank's intermediation nature and their ability to relate with entrepreneurs that I still think is unsurpassed, especially community banks, especially banks that have a strong local presence, but also larger banks that are serious about small business and that may take advantage of big data in order to remain serious about small business. There could be something to discuss. In a way, this really closes my talk. I tried to be a bit more eloquent in a working paper that I would love you to click on and give me some kudos in the process. And I think I can take questions in my last 5 minutes or 10 minutes. I have a list of questions already. In case your question is up there, just to tell you that I'm a bit insecure about what I'm presenting, but I believe is a useful debate.
Thank you. I enjoyed your presentation. I just wanted to mention a couple of things. We know a lot of very large companies that started out with very little borrowing. Apple, Microsoft, all of them started out in garages not needing money. They only went to the markets to have share issues when they wanted to capitalize the rent that they had earned. They didn't go to the market for money that they needed to get started. So then we have a whole range of people who have made money and become angels throughout Silicon Valley and other places where they help fund these startup things for initial equity. I know you want to bring it to a larger group, but we have some of this new economy has been going on for a couple of decades now, where in this new area we've been able to get startups happening with very little borrowing. And I think that's, it's quite exciting to put it together with some of the other things that are happening in finance now. very exciting.
So this is a great question, and indeed is the hardest part for myself to get through. I was chief risk officer in a European institution that is the largest venture capital investor in Europe for 6 or 7 years. What struck me at the time in which we were investing, and I'm not speaking on their behalf, was that you have about, and my paper may be more Euro-specific than US-specific, you have about 100 venture capital teams in Europe that are active and that are able to raise successive funds. And they raise a fund, the fastest of them, every 5 or 6 years. And a fund invests in 10 to 15 companies. Now, you can do the multiplication, 100 team, even if you were 200, 10, 15 companies. It's a very, very narrow, high growth segment in the economy. What I'm interested in here is I think it's fantastic to have venture capital, no critique to that, but we're not interested in the corner baker who wants to open 2 other shops across town. You will not get a venture capital investment in a corner baker or in a orthodontist who happens to be particularly good and wants to scale up. And these might be businesses that have 20 years of history, cash flows, and so forth, but they don't produce a 15% internal rate of return every year, which is what venture capital needs in order to function. So I don't think the venture capitalists will be jealous of the banks if the banks move into this space because they're simply not interested. On the other hand, suppose you have an equity financed enterprise that starts growing and scaling up and has real potential. This is why I talk about quasi-equity, which liquidates after a period. Then at that point, you could create a nice target for private equity to potentially further scale up and bring public. So you could also see these proposals as part of an ecosystem, not as a standalone one, not trying to dismiss other areas.
How about the corporate governance implications of your proposal?
A nightmare. So let me...
That's what I was thinking about.
So you would really have to teach bankers to be bankers again. And there is a real question, but the reason listed companies are listed and the reason we have securities regulators and we have public accountants and we have Sarbanes-Oxley and we have a whole series of controls is because we know that issues abound. It makes a huge difference if you don't have equity and debt in the same firm. It makes a huge difference in terms of how your interests are aligned, because most of the biggest corporate governance mishaps were all leverage related. And this is why it is so key that just think about my proposal as flipping Glass-Steagall over its head. Instead of separating commercial and investment banking, you're separating companies. And separating commercial and investment banking has proved to be a important, useful, but it hasn't survived. This separation is very difficult to enforce, to keep. This is why Glass-Steagall was eliminated, not because people were stupid, but because it was difficult to enforce. Now, I think it has a better possibility of survival at company level under certain conditions. And this is also why I do think that you really need a bank to do this. You need an entity that has a certain hold on a significant amount of information over the company, and then banks are regulated. So you could piggyback on all of the improvements that have been made on regulation, this new securitization initiative, the European data warehouse at the European Central Bank that collects data on companies and others, You can piggyback on this new regulatory to improve corporate governance. I don't think this is for everybody. I don't think this is for every bank, and I don't think this is for every investor. I fully agree with you. Corporate governance in general, a nightmare. This is why this is a debate.
And in Italy, it's war the problem. Another one?
Federico, I've got just a couple of remarks. I very like your idea. I think it's a way to slightly rearrange the process of selecting companies, etc. I would have a couple of just comments. One is that I'm not so sure that you would like the bank to actually invest in equity. I would understand it like being more feasible if it is a quasi-equity, so it is at least one step more senior than the equity that the entrepreneur puts, just to avoid some of these corporate governance Morazad effects. And the other thing is that I'm not so sure that I follow the way in which you read that table, the one with the yellow, because that is not really jeopardizing all your talk, but my impression is that basically the yellow here most of the time is irrelevant. It's just a matter of presentation, because if the respondents are able to just put one cross on one of those, then you would have a nice apple pie, and you would see that bank would be overwhelmingly important in the conclusion, because it's just different ways in which you get credit. So overdrafts, leasing, a mortgage or whatever. And so I think that the only reason why it looks like that is that maybe the respondents are able to put more than one cross, but basically, the only thing that I would draw from it is that, yeah, they don't think that the problem is equity. I think that their problem is access to finance, in the sense that they do not get their loans. So basically, you have SMEs in Italy, you have SMEs in the southern part of Europe, and they don't get the loans. And that's the problem.
You don't get
so
nothing.
I would have a different reading of that.
On your second point, I don't dispute it at all. I chose this because it has nice colors. But if you look at the corporate finance studies about European industries, you find out two things. First of all, the biggest predictor of borrowing is leverage. So companies that already borrow, they tend to roll over their loans. And companies that have no debt tend not to borrow. And if you follow, there are limits of this because it has a 6-month horizon, but there's a number of corporate finance studies in Europe. You could look at the OECD data on enterprises. You find this pattern over and over. There's essentially a large number of firms in Europe, and they are the vast majority who are not interested in that and they may use overdraft facilities, they may use trade credit, but they certainly don't use long-term loans for banks by choice, not by impossibility. I didn't want to overload the presentation, but this is not the only source you look at. There's a number of studies in the bibliography and related sources that will take care of that. The quasi-equity story is really for the self-liquidating nature. I am being pulled by my jacket by the moderators, and is it time for me to stop?
Oh, two questions.
Okay.
I have a quick comment. Your proposal needs to have at least another element to it, and that is the competitive disadvantage that a bank has to lend or to invest money in equity, given the capital requirements that the regulators now require for equity-type investments, for example, on derivative securities, etc., compared to a non-bank institution that invests in equity that is not regulated. It's the same issue in shadow banking with respect to loans. So maybe you'll adjust it for it, but what sort of capital requirements are you recommending for the regulators on this kind of investment?
I have a two-pronged response. One, if you actually look at the volatility of small business private equity holdings, it is less than half the volatility of listed equity. We followed it very closely throughout the crisis, the Euro crisis, the private equity portfolios, partially because they're valued only every 3 months, but they're valued on market multiples. So they're still valued on market multiples. The volatility is much less. But most importantly, this is why I think this proposal does not work if banks are not allowed to securitize this quasi-equity participation. I couldn't think of any other way. I mean, one can fight it out with Massimo and his people, but ultimately, you need to be able to securitize. I think for question of capital, solvency, because these are values that fluctuate, and I think even just as important for question of liquidity, the cash flows are just not predictable. So I fully agree with you.
Thank you. The last one.
My name is Elvis Danko. I'm from Shanghai, postdoctoral. Please, you said enterprise finance enterprise will benefit. Yeah, does it will benefit from low corporate tax? You didn't really explain that. Please, can you explain that? And I have something to add with that. The limited liability principle states that corporate, that is the corporate low corporate taxes. It did not really lower the taxes, but it found a proper way for taxes to be paid. For instance, the corporate itself doesn't pay the tax, but the shareholders pay the taxes. So, and the risk in corporation was even increased. That is, like, they want corporations to take more risk by limiting the liability of the bondholders, of the directors. So the main question here is, how do financial enterprises benefit from low corporate taxes? Thank you.
I'm not sure I get your question 100%. Correct me if I don't. The point is that if you take exactly the same company on the asset side of a balance sheet, but then you try with two configurations, one configuration which is 100% equity financed, and one that is, let's say, 50-50. The one that is 100% equity financed pays 35% tax on their profits. The one that is 50-50 will pay a fraction of that in taxes on their profits. So this is, if I have understood your question, this is my point. I don't want to be more profound than that. It's just pure accounting.
We go back to Corporate Finance 101, no? Tax benefit.
Well, thank you all very much for inviting me. Great pleasure.